Hello everyone. Today we are going to start next chapter of grade 11th accountancy, that is depreciation accounting. Depreciation is a wear and tear of fixed assets. In a business there are lot many fixed assets and their value goes down gradually. The reduction in the value of asset is termed as depreciation. According to standard AS 16, depreciation is a measure of wearing out, consumption, or other loss of value of a depreciable asset arising from the use, affection of time, or obsolescence through technology and market changes. Depreciation is a non-cash expense and it is charged to profit and loss account each year. That means the depreciation is not paid anywhere, but the value which is depreciated every year should be deducted from the profit of that firm, and if it is loss it will be added to the loss. Allocation of depreciable amount is fixed assets over its estimated useful life. Every fixed asset will have a predetermined estimated life. On the basis of that, the depreciation is allocated. Depreciation is based on the cost of asset. Cost of asset differ from asset to asset, that means depending on the technology that is used. So depending on the cost, the value of depreciation also changes. Depreciation is caused due to expiry of time, obsolescence, depletion, permanent fall in price, abnormal factors like accident or any mishappening in the firm. It is due to fading out of asset, that is contrast. Why depreciation is needed? It is needed for determination of net profit or loss, for showing asset at a fair and true value in the balance sheet, provision of funds for replacement of asset, ascertaining accurate cost of production, distribution of dividend out of profits only. That means depreciation is calculated for getting a true and fair value of the asset. When the assets were purchased, gradually at the end of every year, the true value, that is depreciated value, should be maintained, and new funds can also be created to replace that asset. It also is very beneficial for calculating the cost of production. That means for calculating the total production expenses, the depreciation is also taken into consideration. For determination of net profit or loss, that means true value of profit should be taken out when depreciation is also taken into consideration. Factors. Which factors should be taken into consideration for calculating an accurate amount of depreciation? Total cost of the asset, estimated useful life of asset, estimated scrap value of asset, chances of obsolescence, addition to assets, and legal provisions. Total cost, that means not only the cost of purchase but also additional cost of transportation and installation of that assets are also to be taken into consideration while calculating the depreciation. Estimated useful life of an asset, that means depending on the situation, depending on the usage, how long the asset will last in the business and how long will it be in a working condition, that is to be taken into consideration. Estimated scrap value, that is the residual value or the value of asset when its estimated life is over and then it is sold, what will be the scrap value. Chances of obsolescence, that means sometimes it may happen the technology or the asset, it becomes outdated. So how long will it take to get obsolete? Addition to asset, that means sometimes due to expansion, it may happen that the fixed assets can be purchased more in number. So that is addition to the assets, and the additional assets are to be depreciated depending on the time it is purchased. Legal provision, that means sometimes according to certain rules and regulations, the depreciation is to be charged. Internal causes, wear and tear, depletion. That means by constant usage and by constant working of asset, it becomes obsolete or it becomes depleted. External causes, that is obsolescence due to outdatedness, maybe more updated version of the assets are available in the market, so the value of that particular asset goes down. Passage of time, also accident and permanent fall in the price. Accident can also cause the damage to the asset, and permanent fall in price, that is also again due to the upgradation of technology. Determination of net profit or net loss is the need of calculating the depreciation, showing the assets at a fair and true value in the balance sheet, provision of funds for replacement of assets, ascertaining accurate cost of production, distribution of dividend out of profit only, and avoiding overpayment of income tax. Sometimes the incomes are not taken into consideration with the depreciation, and the actual income should be described to the income tax department so that depreciation is calculated and the real income should be taken out for proper tax payment. Factors affecting determination of depreciation: original cost of the fixed asset, that is purchase price, freight, installation expenses, estimated amount of expenditure on the repairs during the during the useful life, estimated useful life of asset after which it will be discarded, estimated residual value or scrap value, possibility of obsolescence, and also the interest on the amount that is invested on the fixed asset, that is opportunity cost. If it would have been invested in some other activity of the business, what interest it would have, that fund would have earned. So that is also to be taken into consideration for calculating the depreciation. Now, assessment of depreciation, that means how we will derive that what is the amount of depreciation for a particular asset. For that, three things are to be taken into consideration. They are estimated useful life, estimated residual value, and historical cost or the revalued amount. That means when the asset was purchased, what was the cost of that asset. Methods of calculating depreciation. It is depreciated in three basic methods. They are straight line method, written down value method, and annuity method. In CBSE grade 11 syllabus, there are only two methods. They are straight line method and written down value method. A reduction in the value of asset over a time due in a particular to wear and tear. That is called depreciation. And for calculating the numericals, we will use only two methods. They are straight line methods and written down value method. Straight line method is very simple and widely used. The company estimates the scrap value of the asset at the end of the period during which it will be used. Scrap value is an estimated value of asset at the time it will be sold or disposed of. The company charges depreciation each year over that period until the value shown for the asset has reduced from the original cost to the scrap value. That means if the asset is of 1 lakh and its estimated life is say 10 years and the, the residual value is 10,000. So how we are going to calculate the depreciation? 1 lakh minus 10,000, that is 90,000, and divided by its estimated life, that is 10 years. So annual depreciation will come to 9,000. 90,000 divided by 10, that comes to 9,000. That means each year from the cost of that particular asset, 9,000 will be deducted, and by the time it will reach 10,000, the estimated life gets over, and 10,000 is the scrap value of that asset. The formula for understanding the straight line method is total cost of acquisition, that means total cost you have incurred for purchasing the asset, minus the residual value or scrap value, divided by estimated life. You will get the annual depreciation of that particular asset. Here we can see one more example. The depreciation here you can see it remains same as it is straight line method. The original cost method depreciation for every year it remains same, and that amount is deducted from the purchase price of machinery. In the first year it was $17,000. From that 3,000 was deducted. Same way every year 3,000 is deducted, and finally the value reaches to scrap value. This is according to the straight line method, and the depreciated amount is accumulated, that is provision for depreciation. So at the end of its useful life, you can see the owner or the businessman will have a fund of $15,000 that he can use for purchasing a new asset or replacement of asset. So that accumulation or that keeping aside of fund is called provision for depreciation. That fund is maintained and it is used for replacement of asset. Next method is written down value method. That is, unlike straight line method, every year the amount of depreciation keeps on decreasing. The amount of depreciation changes as per the value of the asset. Depreciation is charged according to the fixed percentage. The value of depreciation is calculated upon the original cost in the first year, and then whatever the balance remains, that is written down value in the coming year. The rate of depreciation remains constant year after year, whereas the amount goes on decreasing. That means the percentage of depreciation remains same, but the amount goes on decreasing as the balance of the asset reduces. So here rate of depreciation formula is rate of depreciation multiplied by net book value at the beginning of accounting period. Here I'll give you one example. That same way 1 lakh rupees we have a machinery. Rate of depreciation is 10%. For the first year it will be 10% of 1 lakh depreciation. Amount will be 10,000. So the balance is now 90,000. Next year on 90,000, 10% depreciation is to be charged. So for next year the depreciation is 10% of 90,000, that will be 9,000. Same way, the balance will be 81,000. So in the third year, the depreciation will be 10% of 81,000, that is 8,100. And it same way it will go on for the coming period. Here you can see the example. Cost is 10,000 and depreciation is 20%. So on 20% of 10,000 is 2,000, and 10 minus 2 is 8. So this 8,000 is again balance is taken for calculating the next year's depreciation. So this percentage remains same, but the value of depreciation goes on decreasing. Same way, from 8,000 you can minus 1,600, then you can get 64, or else you can add up, sum up both the depreciation, that is 1,600 and 2,000, 3,600. Total depreciation till now, that is 64. Again, this 64 amount will be taken for third year's depreciation. So this is called written down value method or reducing balance method, where the depreciation is calculated on the reduced balance of next year. Here also you can see the same thing, depreciation rate remains the same, but the depreciation keeps on decreasing. Same example to make you more clear, and the same amount is added every year, and at the end of stipulated period there will be a accumulated fund or provision for depreciation. Now what will be the accounting entry for depreciation? As you all know, for depreciation, two things are to be taken into consideration. One is asset and another one is depreciation. So asset is a real account. According to real account, the rule is debit what comes in, credit what goes out. So here it is credited because the value is reduced. And depreciation is a nominal account because it is a loss or expense. So debit all expenses all and losses. Therefore, the journal entry for depreciation will be depreciation account debited to asset account. This was for the journal entry. Now we'll see how the ledgers are maintained for depreciation accounting. Depreciation account is open and every year's depreciation is to be transferred to profit and loss account. This is a simple depreciation account where when the amount of depreciation is charged, that same amount is transferred to profit and loss account. And as you can see here, the depreciation amount is same. That shows the depreciation is calculated on straight line method. Next is asset account. Asset account will be maintained. That means asset is a real account, debit what comes in. So whatever is the purchase price plus the expenses, that will be the debit side of asset account, and the depreciation charge will be on the credit side. So the balance of asset minus depreciation will be next year's opening balance. And same way on 2 lakh you can see 10%, here also 10%. This is for 6 months. So 10% for the entire year is 20,000, and for 6 months it is 10,000. So this way we have to maintain asset account. So the asset account will give the balance at the end of each year after deducting the depreciation. Here also you can see that the depreciation is under straight line method, and the depreciated balance of the asset is to be carried forward for year, next financial year. So this is the format of asset account. Whatsoever asset is given in the numerical, that same asset you have to take as heading. One more account is prepared, that is provision for depreciation account, where whatever the depreciation is calculated every year is to be accumulated, and at the end of a stipulated period the businessman will have a good amount that he can utilize for the disposal or for the replacement of asset, that is new asset he or she can purchase. So in this sum for the first year 28,000, for the second year 28 again, that comes to 56. For the next year again more 28. At the end of the 3 years it is 84. Then again more 28 is added, and at the end of 4 years the businessman will have stipulated amount, that is 1,12,000, accumulated as his depreciation, which he can use for buying new asset. That's all for the accounting of depreciation. Thanks for watching. Take care.